Here's the way it looked. The typical house was about $18,000 back then.
Okay.
If they put 20% down, they borrowed about 14,000. In nominal dollars, the name of them, they repaid about 36,000.
Mm-hmm.
In real dollars after inflation, remember, 1.06%, they repaid 16,000 and change. But after tax benefits and inflation, they paid 12,655. Wait a sec, that was less than they borrowed.
Mm-hmm.
Isn't that incredible?
That is crazy, yeah. Especially when you spell it out like that, yeah. We are live here in the Facebook group Six Figure House Flipper. So we're live. I'm really excited about this one. I have a special guest here. I actually met this person at an event recently, and he gave a talk at the event. I was blown away by the talk because like nobody talks about this sort of stuff. Like he was talking about the economy, inflation, what's happening, what's going to happen, and most important, like how does it impact investors? So obviously we're real estate investors wanting to flip houses, build passive income, all that good stuff. And we're doing these things, and it's very important to like know where we're at and where we're going. Jason is one of the few people who's actually talking about that. So I want to bring him on here, have him share his story. He's an economist. He's an investor himself. He's been doing this 18 plus years. He has a great podcast too. One of the few I listen to. I watch the YouTube videos sometimes, and there's really good stuff. I really enjoy it. It's over 6,000 episodes. I think he has. He's a legend, and
we've got a few. Yeah,
he's been in the space a long time. So without further ado, I want to introduce Jason. How are you doing?
Hey, good, Victor. Thanks for having me, and happy to share some of my latest ideas on how to win the game, as we are in an era of financial repression. Most people are getting hurt by this. Some people who are in the know and who get it and who understand how to play the game will absolutely win, and win big. That's what it's incumbent on all of us to do, is to win the game, to align ourselves with the forces out there, and just win and do as well as we can with it.
I like to think of it like if you're like paddling down a river, you want to go with the current, you don't want to go against it. So that in mind, like you have to know where the current is going, and that's where we need to figure out and like know what's going on with the economy. So I just want to jump into it here. So like what's going on? How do we make the most of it? I know it's a broad question. We'll get into it deeper, but like what's going on?
Sure. So in my position, I get to really interview a lot of experts and talk with a lot of clients. We have thousands of investor clients who are buying turnkey properties nationwide through our network. My company is Empowered Investor, and I've been doing this a long time. So I've been through many cycles. One of the things I just think people have to do is, as much as everything that's going on right now, it is wrong. The elite class is oppressing us peasants, and they're really taking advantage of people. It's very sad. However, we need to align our interest with the most powerful forces the human race has ever known. And by doing that, we can win the game, and really following their business plan. And so that's what I'll share a little bit about today. And, there's a lot to this. So, people can check out my podcast, YouTube channel, whatever, or I can come back and we can go over more stuff and go further down the rabbit hole. Okay.
Yeah, no, for sure. You're invited anytime. Anytime. So you have a bit of a presentation here.
Yeah, I do. So, the most common thing people are probably talking about today is there a bubble?
Yeah.
When will it pop? What's going to happen when it pops? What is that going to mean to people? What is it going to mean to their savings, their stocks, their bonds, their real estate? How is it going to affect them? Because things have been run up so high. Many people say we are in the everything bubble. Years ago, I used to share an article, and I've got to find this old article because, 15, 16 years ago, I used to talk about this. It was an article with Michael Milken, the junk bond king, who actually went to prison, right? You might remember him. And Jeremy Siegel, an economist and investor. And Siegel talked about how there was a looming asset shortage. And I found this to be really interesting because as the middle class rises around the world, as of many years ago, the number's much higher now, the globalization of the economy had lifted about 300 million people out of poverty. Those are mostly people in China and India, but even more now, and I don't have the latest numbers. So people around the world are getting a lot richer. We may not think of them as rich, but in comparison to what they're used to and what their past was like, they feel very rich in China, for example. And so as they are coming up in the ranks, they are now spending money, they're doing a lot of discretionary things, they're investing, they're buying assets. And assets are in short supply. Most people don't think of they think of supply and demand for food and water and housing, but what about just assets as a category? Places to put your money, right? That's a category, right? That's a commodity. Of course, there are different kinds of assets, but assets themselves are in short supply. And so prices have run up as more demand and more dollars or yen or rubles or whatever currency is chasing a limited supply of goods and services or assets. And so when will the bubble pop? That's the big question. I don't know if I have an answer.
Okay.
And, I've had many great speakers at some of our live events over the years, Ron Paul, Harry Dent, a whole bunch of others. And I have software that helps people analyze real estate deals. It's called Property Tracker. And so I'll go through some of that, but one of the things I really think it's important to do is standardize data. So we use this standardized pro forma when we look at a property, so that every time we look at a property, it's the same document. So you don't have to be a detective. You're not as likely to make mistakes or miss something important when you're looking at the numbers. But today, I just thought I'd talk about, some more general concepts about the dollar and this bubble concept and what it means to us all. So if we look at the value of the dollar, and the dollar is a commodity, just like anything else, right? And the value of the dollar has been in steep decline historically over the past decades. And that's why many people have decided to invest in things like gold and also this. That's
what is that? Bitcoin. Yeah. Crypto. Yeah,
it's funny. This is a fake Bitcoin because it's real. It's a real thing. It's tangible, but it's not Bitcoin, right? So it's kind of ironic that a fake Bitcoin is a real Bitcoin or vice versa. And these are Zimbabwe dollars. Okay. Right. Now, these have really no value at all. Okay. But if you look at the denominations, one Zimbabwe dollar in the past used to actually be valuable. And this is 100 trillion Zimbabwe dollars. Okay. So it's kind of funny to just understand that when it comes to currencies like the dollar, it's a race to the bottom. All currencies around the world are pretty much going to zero. Okay, I think we can all count on that. And so how do we position ourselves and how do we win this game? How do we short the dollar, if you will? Look, people talk about shorting stocks. Well, how about shorting the dollar? Because it's almost guaranteed, nothing's guaranteed, of course. It's almost guaranteed that the government will continue to print more dollars and spend more dollars. And as they print more, the supply increases, and as there's more supply, each unit itself is less and less valuable. That's just the law of the world, right? It can't be any other way. And then it chases assets like housing, and of course the price goes up in nominal dollars, but not necessarily in real value, right? So that's the thing. There's this
interesting.
Yeah, go ahead.
Oh, no, I appreciate it. I didn't mean to cut you off, but no, it's interesting. Like the value of the dollar is going down, not necessarily like the value of the house. Like the house is a house, but like the value of the dollar is going down, but it's just more dollars to make that same amount of value.
Exactly. And, we should really ask ourselves, is the price of the house going up, or is the price of the Bitcoin going up, or gold, or, whatever, or is the value of the dollar going down? And that's a real good question. Right. So most people think, prices are going up, they're going crazy. But, price is just a name. It's like a Zimbabwe $100 trillion bill, right? That's meaningless. It's just add some zeros, right? It doesn't really mean anything. What's valuable is what it can buy, right? So that's the thing. So how do we do this? How do we play this game? So many years ago, I trademarked this phrase, inflation-induced debt destruction. I know it's a mouthful, but it's really important because this is the strategy that can help people win the game. Inflation-induced debt destruction. Say it 3 times fast.
So what does that mean exactly? And because I work with a lot of beginners, so what's inflation? Like, what do you mean by all these terms that you just threw at us?
Great question. So inflation happens when there's a increasing supply of currency units, in our case the dollar, but it could be the euro or the yen or the peso, doesn't matter, just whatever it is. There's an increasing amount of these currency units, and they are chasing a limited supply of goods and services. And so naturally, by the law of supply and demand, the most basic law of economics, sellers of the goods and services will raise the price as more and more currency units are trying to buy them, right? So that's why a house, years ago cost $50,000, and today that same house is $300,000, right? Because more currency units have come into the system, chasing the limited supply of housing. And housing is such a great asset class because its supply, Victor, is extremely limited. It's limited by so many things. Number one, of course, there's a limited supply of land.
Right.
But really, if you think about it, there's a lot of land in the world, right? But there's a limited supply of land where people want to live, where cities will entitle them to build, and all of this kind of stuff. And then all of the construction materials. So if you look around, my office here in my house, right? Hey, look behind me, that wall, inside that wall, well, of course, there's drywall on the outside or gypsum. There's brick and 2x4s and nails and copper wire and petroleum products. And below me is concrete and then, flooring materials. And in front of me is glass and steel. And so all of these commodities have intrinsic value. It doesn't matter what currency you price them in. Every human needs these things because they are the ingredients for shelter.
Right.
Okay. So that's a beautiful thing because when a commodity is not attached to any one currency and has intrinsic value and is needed by every human being on earth, you got a really good recipe there for an investment. Okay. So yeah, really good thing. So inflation-induced debt destruction, well, it's better if I just talk about it.
Okay, that's fine.
Maybe. Okay. So we've got Janet Yellen and Joe Biden, and they're spending money like drunken sailors.
Fair, yeah.
I remember Ronald Reagan had this great quote years ago. He said, "To say that the government spends money like a drunken sailor is an insult to drunken sailors."
That's a good one. I haven't heard that one before.
Because the government spends more, right?
Yeah.
It's crazy. So what do we do? Like, what does the government do, right? It's so in debt and it's made so many promises that it just can't keep. Mathematically, there's no way to keep it. So just to understand like the size of the problem for some reference. So the GDP of the country, in other words, everything the United States produces, all value produced in the country economically every year, is just over about $20 trillion. We'll just round it off, call it 20 trillion, okay? With a T, that's trillion. And the problem the government has is all of the promises it's made now and into the future, right? And over the next 10 to 15 years, I believe the most reliable estimates of those promises as they stand today, but remember, the government every day keeps making more promises that it can't keep mathematically. But today, those promises are about $220 trillion.
Okay, so there's a misbalance there. Yeah. So
total mess, right?
Yeah.
So think about it. If you taxed everybody at 100% and said all 20 trillion needs to be paid to the government every year and the people get nothing, right? Well, obviously, no one would work and the economy would stop working if that happened, right? But just say you did. And if the government never made another promise after today, and you tax everybody at 100%, just to keep the promises it's already made, it would be 11 years of the entire country's GDP. It's an impossible
It's
thing,
not going to
right?
happen. And these
Yeah.
are promises like Medicare, Social Security. Can you explain like the promises?
Disability
Okay.
insurance, government contracts, government
Mhm.
employees, it's just insane. It's just gotten so far out of control. It's ridiculous. So I've identified 6 ways the government could potentially get out of the mess.
Great.
Some will work, some won't. Okay, let's look at them. Number one, the government could just default and say, look, we're sorry, we made too many promises, we're drunken sailors, we can't keep the promise, so we're going to institute austerity measures, and
Okay.
we're just going to break the promises. All the debt we owe to foreign countries, we're just going to say, sorry, we can't pay. And then all the promises we made to our own people, we're just going to say, sorry, we can't give you Social Security or,
Mhm.
whatever, right? And so that would be very unlikely, as we saw in Greece and
Yeah.
Spain and all over Europe and many other countries around the world. We saw riots in the streets when austerity measures were implemented. So
Yeah.
very unlikely, politically intolerable. Raise taxes. Well, that was the one we already talked about. Tax
Mhm.
people to 100%, and you still can't solve the problem. Okay, so that's not going to work. We could sell off assets. The US could have its own garage sale, right? It's a yard sale. Years ago, we talked about selling our ports to Dubai. Regularly, the Bureau of Land Management, not to be confused with the other BLM, okay,
Oh, I was about to ask. Yeah.
sells off land, okay, sells off land to developers and so forth. So the country does have assets it could sell. Some of the toll roads in our country are actually owned by foreign companies or governments.
Okay. Yeah.
So when you pay a toll, sometimes you're paying China. Isn't that
Hmm.
weird? Yeah, in our
I
country.
didn't know that. I did not know that.
Yeah, it's kind of a strange way to take over a country right there. Okay. So we could use the American military to steal the assets of other countries. And,
Okay.
people might say, well, that's crazy. Are you kidding me? Well, are you kidding me? It's the history of the world. This
Mhm.
is how the map of the world was created, by one country's military imposing and trying to steal the resources of another country, whether the resources be land, oil, art, gold, whatever, right?
Mhm.
This is the history of the world. It's ugly, it's terrible, but it's reality. Okay. Now, on the good side, I've been really negative. Okay. On
Fair.
the positive side, maybe there will be some great technological innovation that'll
Mhm.
change everything and make everybody prosperous. Let's hope that happens. Let's hope that happens. And when we talk about inflation versus deflation, we're really talking about a war. We're talking about a war between two things: really bad fiscal and monetary policy, in other words, all the spending we're talking about,
Yeah.
and technological innovation. Because technology is deflationary, but
Mhm.
bad fiscal and monetary policy is very inflationary. Okay,
Mhm.
so who will win this boxing match or this war? I don't know. We'll see, right? I kind of think the bad fiscal and monetary policy will win, and I don't mean win in a good way, but I
Mhm.
think they'll create inflation because that's virtually unlimited. Technology is pretty amazing, but it's not unlimited. Okay,
Right.
it's
Okay.
always limited by prior discoveries and whatever people can think of at the time or manufacture, right? So the most likely thing will be inflation. The
Mhm.
government will simply inflate its way out of the problem.
Okay.
So this is what we should all do. We can just align our interests with the
Mhm.
government and the Federal Reserve
Yeah.
and benefit from all this inflation just beautifully. Now, most people in an amateur way will say, well, you're not telling me anything new here, Jason. I already get that real estate's a good hedge against inflation. Uh-uh. There's way more to it than that. Okay. So if someone watching this or hearing this is thinking that, there's more to it. Okay. Let me tell you, there's a lot more to it than that. So let's dive deep into this inflation topic. So to understand inflation, we need to differentiate between real and nominal. Nominal means the name of something, like the Zimbabwe $100 trillion bill. Where is it? Here it is. It's called 100 trillion Zimbabwe dollars. But what is the value of it? Well, the value of it's almost nothing. But the
Mhm.
value of it used to be a lot. Okay. And that's the name. The name is nominal. It's just the name of something, not the value.
Mhm.
And so we also need to understand that inflation is this hidden tax that just steals our money. It robs us. It destroys our purchasing power. And it destroys the value of savings in our savings account, the value of our stocks, bonds, and even our equity in real estate. because all of those things are denominated in dollars. So anything denominated in dollars gets attacked by inflation. Guess what? Debt is also denominated in dollars.
Which is good. Great.
And that's wonderful because it gets attacked by inflation too. And that's why debt, Victor, is my favorite four-letter word.
Oh, there we go. Yeah. I've always heard with inflation, there's two losers, and that's savers and lenders. So don't be those two things and you'll do good.
Yeah, you got it exactly right. Exactly right. In fact, that's one of the things I'm going to say. So is the most powerful method to redistribute wealth, not taxation, inflation, much more powerful and much more sly. And it does transfer wealth, just like you said, from lenders to borrowers and from old people to young people.
Oh,
so
interesting. I never heard
old
that
to
one.
young, yeah. Why would that be? Well, mostly old people, at least hopefully, have assets. Guess what they have? They have the stuff above: savings, stocks, bonds, and equity in real estate. And guess what most young people have? They have debt. So inflation is an intergenerational wealth transfer without an inheritance, without anybody dying. It's just transferring wealth every single minute. Okay. So, not that young people have the good kind of debt most of the time. They have student loan debt or credit card debt, and that's all bad, but it's still debt. So it does transfer some wealth. Okay. Now, one of the things we have to understand that's really unfortunate is that when a government is broke, it becomes predatory on its citizens.
Okay.
And this is ugly, right? And I used to live in the Socialist Republic of California most of my life. Thankfully, I now live in Florida. And I just noticed over the years how predatory the government was getting. I remember talking to a taxi cab driver. This was before Uber. And he was talking to me about how he got a speeding ticket and he missed the notice, and suddenly that ticket turned into a $1,000 fine.
Really?
And he's a taxi cab driver. He couldn't afford that. Okay. Yeah. And so the government just becomes very predatory when it gets broke. Okay. And that's unfortunate, but it's just a thing we got to understand, and we need to defend ourselves from it. So how does this really work? Inflation-induced debt destruction. So let's look at not a theory, not a philosophy, but a reality that already happened to millions and millions of people. So in 1971, Richard Nixon took us off the final attachment to the gold standard. It was almost exactly 50 years ago. And he basically said that, look, countries around the world can no longer convert their US dollars to gold anymore. Before that, they could do a conversion, but they couldn't do it after 1971. And so when we went off the gold standard, that broke any tether that the government had to limit its spending. And after that, the government could just spend whatever it wants to. We all hear these, debates about the debt ceiling and all this stuff. They can just keep going. There's no limit whatsoever. Gold provided a limit before, because there was a convertibility. And if you were going to convert the dollars to gold, then guess what? If there's more dollars being pumped into the system, the price of the gold would naturally go up. Right? Because it's supply and demand. More currency units, limited supply of gold. So that's inflation, right? Or inflation in gold prices, or devaluation of the dollar. So let's look at 1 year after Nixon took us off the gold standard, and look at a home buyer who bought a house in 1972. Now, this happened to millions of people, so it's not a theory at all. Okay. So at the beginning, when they got their mortgage, $1 was worth exactly $1, because no time had passed, no inflation had happened yet. But by 1984, the dollar was only worth 40 cents. So in 12 short years, the dollar lost 60% of its value. I mean, that's
crazy. That's a lot.
It's shocking. And 12 short years is nothing for to lose that much. And that's not even considered hyperinflation or high inflation. When you look historically around the world at Zimbabwe, Argentina, Hungary, a zillion other examples, Russia, when the Soviet Union collapsed. I mean, this is nothing in terms of inflation. It could be much more severe in the future. So $1.40. Okay. By 2001, now people are paying off this 30-year mortgage. Remember, the mortgage was fixed rate.
Yeah.
By 2001, the dollar was only worth 24 cents. Now we lost 76 cents on the dollar, right? What happened? Okay, in 1972, this person, to get a mortgage, borrowed that money at 7.37%. That was the mortgage rate for a 30-year fixed rate loan.
Okay.
And after inflation devalued the debt, after inflation-induced debt destruction, they really only paid a real rate of 1.06%.
Oh, interesting. Okay, because you're taking out the inflation. Yeah, so they almost lived there for free, almost.
Almost.
Yeah.
But wait, there's more, as they say on that 2 a.m. infomercial. You get some more Ginsu knives with this thing. Okay, so it gets better than that, because interest on your mortgage is tax deductible. Now, everybody's tax rate is different, so this is just an estimate, understand that, but it's kind of like a typical scenario. After inflation and tax deductions, they paid negative 1.16%. So they did get paid to live there. They didn't just live there for free. They actually got paid to live there. And this was an owner-occupied home. Imagine, Victor, if it was a rental property.
Yeah.
Where you're not even paying your own debt. The tenant is paying the debt, and they're paying you maybe $200-300 a month positive cash flow. And the at least nominal value of the property is going up every year.
Right.
That's what people consider the hedge against inflation. But they don't consider the inflation-induced debt destruction. That's the beautiful part. It's the hidden wealth creator. So here's the way it looked. The typical house was about $18,000 back then.
Okay.
If they put 20% down, they borrowed about $14,000. In nominal dollars, the name of them, they repaid about $36,000. In real dollars, after inflation, remember, 1.06%, they repaid $16,000 and change. But after tax benefits and inflation, they paid $12,655. Wait a sec, that was less than they borrowed. Isn't that incredible?
That is crazy, yeah. Especially when you spell it out like that.
Yeah, it's totally amazing. Now, I developed an index that you saw a little bit of it at the conference where I spoke. It's called the Hartman Comparison Index. And what it does is it compares the price, if you will, of housing to a whole bunch of other commodities. Remember how at the beginning we talked about how commodities have intrinsic value?
Yeah.
So it's much better to compare the price of anything against many other things. Most people make this huge mistake, Victor, of only comparing to one thing, the dollar. Why would we only compare it to one thing? Because that thing keeps changing in value. So it's a measuring stick that keeps shrinking or growing, and I don't know what it means. It means different things every day. I mean, there are currency traders that make a whole living or make, millions or billions of dollars trading currencies because the currency's value changes all the time. Okay. That's the Forex market, right? So why would we only compare the price of, say, real estate to dollars? We would be crazy to do that. That just doesn't make any sense at all. We should compare it to a whole basket of things like gold and Bitcoin and oil and orange juice and rice and all of these different commodities that everybody uses regardless of the currency. If currency didn't exist, everybody would still use oil and oranges and gold.
They have to do something. Yeah, exactly.
Yeah, all of these things have intrinsic value. So that's what we can talk about next time. It takes me a little while to go into it. So it's
that's an interesting topic for sure. Yeah. So it's compared to what is the Jason Hartman question?
I'm glad you remembered. Yes, compared to what? Absolutely. Yeah. So any questions or thoughts or any maybe
really fascinating because everyone says everyone talks about inflation, but what does it mean? How does it apply to us? How do we fight against it? Okay, it's one thing. Okay, inflation it's here to stay. What do we do about it? I like the idea to just invest in real estate, have rental properties, do flips as well. Just get your foot in the door with real estate and take advantage of the currents that are running and really take advantage of that.
Absolutely.
It's powerful.
So what do you do specifically? So I have another strategy I teach called the ultimate investing equation. Okay.
Yeah. What's that?
And part of that equation is this: you acquire assets that everybody needs, those are houses, right?
Hmm.
And you acquire them with mostly someone else's money. That's the money you borrow from the bank. So
Hmm.
maybe you're going to borrow 80% of it, put
Yeah.
20% of your own cash into it. And you delegate the responsibility of repayment of the mortgage to the tenant. You don't pay it yourself. Okay. And you tell the tenant to give you a little extra every month, positive cash flow.
Hmm.
And you take great tax benefits because income property is the most tax favored asset class in America. And this is just a beautiful, beautiful equation. So don't pay your properties off. If you've paid them off or paid them down, refinance them and pull the equity out,
Hmm.
buy more properties and leverage them with long term fixed rate, super cheap debt at negative interest rates. So let's talk about negative interest rates before we wrap it up.
Yeah,
Okay.
please.
I mean, are you getting mortgages for your flips or using hard money or just your
Yeah,
own
typically
money?
hard money. Yeah, typically
Okay.
hard money. And just to interject also there, I also recommend for folks like, because a lot of people want to do rentals, passive income. I recommend like do a flip, do a rental, do a flip, do a rental, just to help you get into the rental game.
Yeah.
Because rentals are where it's at. Like there's a lot of benefits to that, just like you're saying. And passive income, everyone's all about the passive income, but they miss out on some of these other benefits. Like if they're getting paid to own the house,
Right.
it's negative real interest rates, then even better.
Yeah, no, you're absolutely right. So that's a good idea. Do the flip to get some capital to buy the
Yes.
long-term thing,
Yeah,
right? Most people, they'll do the flip and go spend the money because they're instant gratification oriented, right? But what
exactly.
you should do is do the flip and buy a rental and then do
Mhm.
another flip and buy another rental and keep it and
Exactly.
sell one, keep one, sell one, keep one. That's a really
Mhm.
good method.
Okay.
Um,
So yeah, so negative real interest rates.
yeah. So if someone is borrowing on a long term, and by the way, I'm a hard money lender. So if you or
Oh,
anyone,
okay.
any of your students need funding, I fund, flips all the time. Okay.
Mhm. There we go.
Because I don't want to be a long term lender, but I like being a
Interesting.
short term lender because inflation will kill me long term, right?
Yeah.
But for 6 months, I'll loan the money, right? And do hard money. So anyway, if on that long term rental, they're borrowing at like 3%.
Yeah.
I mean, it's incredible. Maybe, give or take, an investor is going to pay a little more, but let's
Mhm.
just call it three for example's sake. Okay. And say their combined state and federal tax bracket is 50%. If they live in the
Mhm.
socialist republics of New York or California or Massachusetts or whatever, right? They're going to pay about 50% probably. Okay. And for round numbers, we'll use 50, right? Maybe it's a little
Mhm.
less. So that 3% interest now becomes, after taxes, 1.5%
Mhm.
real interest rate.
Yeah.
But, the official inflation numbers would say inflation's around 4% right now, which is quite high actually. But the real inflation rate, if you ask me, is about 10 to 12%. Don't believe the CPI because the government has a conflict of interest. They
Yeah.
have a vested interest in understating it.
Mhm.
So look at something like the Chapwood Index, which I like, or shadowstats.com. And I've
Mhm.
had the founder on my show. He's really interesting, John Williams. And, if you think the inflation rate is, let's just call it 4% to go with the
Mhm.
official number. So we
Mhm.
paid 1.5. Now, if we subtract 4% from 1.5, because it's the interest rate versus the inflation rate,
Yeah.
right? Now we're at negative 2.5%. Pretty good deal. We're
Not
getting
bad.
paid 2.5% to borrow money,
Mhm.
assuming a tenant doesn't pay the debt.
Oh, interesting. So that's just owning it, not even renting it out, or
If
doing
we
something.
owned it and left it vacant,
Yeah.
now granted there'd be some maintenance costs and there's property taxes and insurance. I get it. Okay,
Mhm.
but that's relatively minor in the big scheme of things. Okay.
Mhm.
But if we put a tenant in and tell them to pay the debt for us and give us a tip every month of $200, that's kind of a typical deal, right? Then it's like an infinite return scenario.
Mhm.
It's just totally incredible, right? So negative interest rates. Now, what if the real inflation rate is 10%? We used 4% before.
Right.
I
Which
mean,
is probably what it's closer to being. Yeah.
yeah. So 10%, so 1.5% minus 10% is negative 8.5
Mhm.
if we pay the debt ourselves.
Yeah. Yeah. So if you start thinking in this way, like if you saw someone advertising a house, or like if you saw a mortgage company like advertising a loan, it's like, we'll pay you 8%. to buy this rental. Like, I mean, how many rentals would we be buying? It'd be like,
Yeah.
how many can I handle? What's the maximum?
Yeah. Yeah. And look, why do you think all of these big institutional investors are just crazy about buying more houses? They're building to rent communities, build to rent deals, right? Because they can get this money so cheap on the public markets that it's just an incredible deal for them.
So they're really thinking long term. Yeah. So with that in mind, and then we'll wrap it up. So the final question, like, is the housing market in a bubble? Do you think it is, or do you just really think it is this inflation that's kicking in?
Well, it depends.
Okay.
One of the things we'll talk about next time we meet, and we're going to do the comparison index, which really answers the bubble question really well. Okay. Inflation is sort of inflation-induced debt destruction is a technique to short the dollar that can protect you from a bubble. But the bubble question is answered mostly by the Hartman Comparison Index and the compared to what question.
Oh, okay.
And also we're going to talk about next time how there are 3 types of markets: linear, cyclical, and hybrid markets, and how those are all different. So you can't really classify and say, well, is real estate in a bubble? Because it depends where it is, what price segment it is, what property type it is. You got to peel the layers of that onion a bit. Okay.
Gotcha. Okay.
But mostly, I will answer the question. In my opinion, mostly no. I don't think we're in a bubble yet. In fact, Goldman Sachs, I say that intentionally. Goldman Sachs has a new report out that says housing will appreciate by 16% next year.
You're kidding.
Nope, not kidding.
And was it what was it last year? Was it 17% or what were they saying?
Well, it depends what market and what survey you're going by, and I don't know what Goldman Sachs predicted last year. I'm not sure.
Yeah. Okay.
But I know that really next year for 2022, they're predicting 16% appreciation.
You're kidding me. Jeez.
So, I don't think we're at a bubble yet. I think people think real estate's expensive because they don't compare it to the right things. They just compare it to dollars.
Right. And if you just see the price tag, it's like, oh, the price tag has gone up, so it must be worth more. Well, fantastic. Yeah, I think that's a really good place to wrap it up. We can leave it on a bit of a cliffhanger. So we definitely have to have you on again just to hear like the second part of it, maybe even third part of it. But again, appreciate you hopping on. It's been a pleasure.
All right. Happy investing, everybody.